Hey everyone, my name is Roderick V.
My name is Katie Tegenkamp,
I'm Ryan Jeffers.
I'm Gregory Page.
And I'm Riley Timbrook.
and we are Group C presenting our case report on the NYSA Resources Corporation. So some of the details of the case. NYSA Resources Corporation is looking forward to investing in a new project that will increase the company's stakeholder wealth. It has a choice among 4 different projects as well as important offshore oil concessions, and each project has been examined by the World Bank. This bank is willing to finance any of the high-risk projects, but it can only finance a total of 3. At a minimum, one project must be selected to obtain the oil concession, so it must be a 4 and 8 project. Additionally, NYSA has already spent $75 million on geological surveys. If NYSA takes on a project, then it needs to spend an additional $15 million on wells to determine the size of an oil field. So based on these oil wells, there's a 65% chance that the field is viable, which means a project can occur. And if the project can occur and the field can be developed, NYSA will need to invest an additional $50 million in storage, transportation, and development wells. The expected annual return of the well has 5 possible outcomes, and the estimated life of the oil project has 5 different outcomes, making it a riskier project than what NYSA would usually take on. So the 4 possible projects that NYSA is able to invest in they're labeled A, B, C, and D. Project A is a creation of a runner plantation. The plantation will have no income for 10 years, but at the end of the 10th year, the plantation will be worth $465.66 million. Project B is a deepwater seaport. The seaport has projected revenues of $12.745 million a year for 10 years. Project C is an airport facility that the revenues will increase as Cayenne's economy develops. And Project D is a strip mining operation. The strip mine will have a high initial revenues, but will diminish until the end of year 4, where the mine will be completely exploited.
The question 1 of our case asked us to determine the required rate of return looking at table 2. So what the company did is they predetermined a required rate of return for 16% for all the project A through D. However, as we mentioned later on, each project had a different cash inflow as well as a different risk. Therefore, the required rate of return should be different. So if each project presents a different risk, then our project can only be as risky as the riskier cost of capital across all U.S. firms. So for all small oil drilling and exploration companies, the required rate of return is 26% with a risk index of 6.8, which among all investment, this is the highest in terms of risk. So we just for every project, we're going to use 26% as of our baseline. The internal rate of return for the oil concession appeared to be 32.506%. We took in consideration the 15 million and the additional 50 million that needs to be done in order for the project to be doable. So this came up as a $65 million investment at the beginning. We didn't take into account the sunk costs because sunk costs are costs that are already incurred and cannot be recovered. So we just took them apart. For question 3, the internal rate of return can be seen on the table for project A through D. In order, project B has the lowest internal rate of return with 22, project A following it with 25, and project C with 27.99, which is the first project over 26%, and finally project D with 27.2%. So according to the table, if we base our final decision of accepting or not a project only on the RR, since we know that our baseline for the required rate of return is 26%, we would accept only C and D. Considering the payback period for our project, this is an important data to look at. However, this is not going to be our first factor in determining whether we accept or not a project. The issue with a payback period is that after the break-even period comes up, we don't take into account the aftermath cash flow. So project D is the lowest one in terms of break-even point with 1.41 years, and then just going up from project C with 3.8 to the maximum of years, which was project A with 9.89 years.
So for question 5, we were asked to calculate the internal rate of return for all the projects when combined with the oil drilling concessions as well. So we have the Excel sheet there visible, but for project A and the oil drilling concession is 27.26%, project B 27.51%, project C 30.12%, and project D 31%. So as a main decision factor, they're all acceptable, being that they exceed the required rate of return of 26%, but then obviously further factors have to be considered, things like the timing of the cash flows and the net present value of those projects as well before a clear decision can be made. For question 6, we were asked to calculate use the CAPM to determine the risk-adjusted discount risk of each project. And so then again, there we have shown in the PowerPoint slide the individual betas in those calculations of project A, that being 26.02%, project B 23.98%, project C 29.98%, project D 28%, and then for the oil drilling project 28% as well. Then for question 7, we were asked to calculate the weighted average beta coefficients for each. So we were provided the regular beta coefficients and then asked to do the weighted average. So the way you do that is you combine each individual project A through D with the oil drilling concession and treat that essentially as the total cost of the portfolio. And then from there, use the provided beta calculations and apply that weighting to them. So essentially you would create project A divided by the total cost of project A and the oil drilling concession as its weight, and then that would give you the beta ratings for A, 2.83, for B, 2.66, for C, 3.17, and for D, 3.00. And so those are all combined with the oil drilling concessions. Going purely off of the beta rating there, the weighted average beta rating, the least risky decision would be to choose project B combined with the oil concession, but again, there are other factors that have to be considered, like the net present value and different internal rate of returns, as we see later.
So in addition to the 4 possible projects that NYSA might invest in, they're also considering lending $50 million in a loan to Wellesley Haverford, and they're calling it Project X. So the beta of the project is 0.4. The rater is 12.4% used, which was calculated through the CAPM. And then the interest rate is 15% of Project X. And then using the CAPM graph, the average cost of capital is 16%. So the problem statement was the board was unsure if they should extend this loan to the company because the interest rate was below the average cost of capital, even though it was a low beta, meaning that the project is not volatile like the market, and it will actually make the portfolio a safer investment and less risky than it would without it in it. So using the rater and the interest rate, which is the expected rate of return, you would accept the project or extend the loan because you need to ignore the cost of capital, because making investment decisions based on the cost of capital ignores factors such as the low beta or the low risk, and sometimes it can mislead you into accepting projects that are higher risk with lower returns. So you should also you should accept the project because of the low beta and the expected rate of return is greater than the rater of Project X, making it an undervalued stock, which is a good investment.
Greg, you're muted right now.
In question 9, we have to determine the net present value of projects A through D while using the risk-adjusted discount rates from question 6. When doing the net present value, all of them return back with a negative net present value, and then we're later asked to use the net present values in combination with the the offshore oil project, and we come back with project A along with the oil offshore being 2.983 million in the net present value. Project B being 3.839 million. Project C being 3.691 million, and then Project D along with the offshore oil being 6.26, which was the greatest of all with the net present value, thus us choosing Project D to undertake.
For question 10, we were asked to defend or criticize Robert Tyson's suggestion to accept project B or C as our foreign aid project. These were the projects that he believed if the economy of Cayenne were to boom, that it would positively affect these two projects. Our criticisms are that the concession may not be successful. It could end up being worth it, or it could end up booming and helping out those two projects, but the concession may not be successful, so we have to watch out for that. With the concession not being successful, it will then hinder the economic growth which those two projects are tied to. The other two projects, projects A and D, could be used to hedge against an unsuccessful concession, and projects B and C don't have the highest return, and that's why we're criticizing Robert's suggestion. For question 11, asked us what kind of information would be useful to make these decisions, and also discuss the feasibility of these information and how you could obtain it. One thing that we would really like to know, kind of relating back to question 10, is what would be the expected rate of an economic boom? And that would be very difficult to obtain. It's not something that's very easy to figure out. However, if we were able to figure it out, we would want to use a more conservative estimate so we're not overestimating the potential cash flows that would bring in from an economic boom. And we would need to see how the boom would affect projects B and C, and then use a conservative estimate so we're not overestimating. And then for the final question, based on all of our previous answers, which of the projects should NISA accept? We decided that Project D should be the only project accepted as our foreign aid project. It has one of the highest individual IRRs, the highest IRR when combined with the oil project, lowest payback period by itself, highest NPV with the oil concession, as you saw in question 9, and it's not tied to the economic growth of Cayenne. So if the oil concession doesn't work out, we won't be as effective. And that is the end of our presentation. We will answer questions, I'm sure.